InFi, episode 41.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey, everybody. Welcome back to the InFi podcast. Today, my guest is Dr. Michael Dooley, who's the chief economist at Figure. And Figure, we have alluded to a few times on this podcast. We've had guests who are either directly or indirectly connected with them. So there should be a familiar name to you folks. But here, Dr. Dooley is serving in his capacity as the chief economist at Figure. So let me go ahead and read from his official bio, and then I'll talk about what our conversation covers. So Mike Dooley is Figure's chief economist. He's professor emeritus at the University of California, Santa Cruz, and a research associate at the National Bureau of Economic Research. His academic career followed more than 20 years of service at the Board of Governors of the Federal Reserve System and the International Monetary Fund. At the Fed and the fund, he was responsible for a variety of judgmental and model-based economic forecasts. He was chief economist for Latin America at Deutsche Bank and a partner in Cabazon Capital. His published research covers a wide range of issues in macroeconomics, including work on financial crises and liberalization of financial markets. So the specific reason I wanted to get Dr. Dooley on the podcast here, I came across a post that he had at Figure's website. This came out May 2nd, 2024, that he co-authored it with Mike Cagney, the head of Figure, where they were discussing their views that they thought the Fed was not about to cut interest rates, and in particular because they did not see a recession baked into the cake the way a lot of analysts are predicting. And so they just went through and gave their analysis. And the reason I was particularly interested is they do bring up the inverted yield curve. And they say, we know a lot of analysts are thinking because the yield curve has been so inverted for so long that means, oh, surely a recession is just around the corner. And they disagree with that. And since that's something that I have been arguing, I think at least once here on the podcast, but certainly also in my articles at the Infinio website, I thought, okay, this is interesting. Somebody I respect who's disagreeing on this topic. Let me bring him on just to give you folks a wide range of viewpoints so you can make an informed decision for yourself. And also, to that end, he also disagrees with the views on the labor market that our previous guest on the podcast, E.J. Antony from the Heritage Foundation, what he was telling you folks. Okay, so again, here, there's not a party line. If I see interesting guests that I think are going to make a compelling case for their point of view, I get them on the show here to let you folks make the final decision. One last caveat here, just so you know, if you're watching the video version of this interview, on his end, Dr. Dooley had some issues, and so he's on his phone, right? So the framing might look a bit different from usual that he had to conduct this interview on his phone. So without further ado, here is my discussion with the chief economist at Figure, Dr. Michael Dooley. Mike, welcome to the InFi podcast.
Thank you. Nice to be here.
So the point of having you on, as you know, is I want to go through this recent article that you co-authored with Mike Cagney about interest rates and particularly the inverted yield curve, because that's something I've been writing on myself. But before we dive into that, can you just explain, your build as the chief economist at Figure? Can you just explain what Figure is? We've had people on the podcast before from Figure, but just for those who don't know.
Yeah, it's what people popularly call a fintech firm. Most of their business right now is in refinancing mortgages and HELOCs, but it also is ambitious to modernize lots of securities trading. And so they're in the process of dividing into two different entities, one which will focus on trading and one which will focus on developing new products. And that's just getting started. It's an outgrowth of a long career, particularly with Mike Cagney, where he's been a leader in developing blockchain technologies, and he started SoFi, and this is his second enterprise in this space, and is doing quite well. So I've pretty much helped them with broad macro developments, how it might affect the mortgage markets, how it might affect refinancings and that sort of thing.
And you're a PhD economist, right?
That's right. I got a PhD from Penn State. I've worked as mostly in international finance. I worked at the Federal Reserve Board of Governors, at the IMF and Deutsche Bank and the University of California, Santa Cruz.
Okay, great. So I'm also, in case you don't know, PhD economist, most recently at Texas Tech. So given that we've got two econ nerds here, let's talk yield curve. So I'm referring to, of course, folks will link to this, but you and Mr. Cagney had an article or a blog post at the Figure blog that was originally published, I believe, May 2nd, 2024, called Higher Rates for Longer. I'll just read the opening blurb. The economy is not slowing down, even with the weaker Q4 print. Inflation's not slowing down. The Fed won't cut rates in this environment. While mortgage rates will stay elevated, housing will be supported by low inventory. We aren't going back to the cash out refi boom of COVID, but should continue seeing record home equity tapped via HELOC / seconds. So do you maybe want to just respond or amplify some of those main takeaways, and then we'll dive into the details?
The general mindset, or what we have been arguing for some time now, is that people's expectations about where the economy is now have been heavily influenced by what they expect to happen. Most market participants now expect some kind of a downturn. And so when they expect it, they see it. One of the things that struck me over all the years, I've done a lot of forecasting, is that perhaps your biggest challenge in forecasting is knowing for sure, or knowing with some degree of certainty, where you are now. Mm-hmm. Right? So this is a big, complicated economy, and there's lots of data that comes. Looks like there's a lot of numbers that come from it, but actually surprisingly little information about where we are at the moment. I mean, you can review all the numbers in a few minutes, frankly, that we have on where the economy is right now. And today is a good example. I mean, in the last couple of days, the market's gotten all excited that basically saying, oh yeah, we're right. The economy is slowing down, inflation is slowing down, the Fed's going to cut interest rates, and we're going to live happily ever after. Where we come from, or where I come from in particular, I don't want to implicate Cagney too much in this, but where I come from is from the experience of looking at many, many countries at the IMF, I was responsible for many years, in reviewing programs, IMF programs. And IMF programs, as you know, are based on how the economy is doing now. Do they need to borrow money? What new policies do they need to pursue? And I was struck in doing that. I had to do it for a bunch of countries. You got to do it fast. I was struck that as a general tendency, if you read the commentary, the narrative, done by all excellent PhD economists and approved by the central banks and so on and so forth, you get one view of what's going on. If you just look at the numbers at the back of the report, which you can do in about 1/8 the time or 1/20th the time, you often get a different view. And so this is strange. How can the raw numbers that I can process pretty quickly be at odds with the consensus forecast? And they were consensus forecasts in the sense that the IMF staffer and the government had to agree to this report, right? And it struck me at the time that everyone's interpretation of the numbers is heavily influenced by what they expect to happen. And I think that's a real problem. So while in this particular example, everyone's expectations have been conditioned by a view that there's going to be a recession. My view is that, okay, that's fine. So I try to take out all of the information, quote unquote, that involves any degree of expectations out of the calculus. Mm-hmm. Look at only the numbers, so if you ask somebody, like in the ISM numbers, lots of the numbers that we put together, often half the questions are based on asking, for example, firms, what do you expect to hire more people over the next year? Well, I throw that question out, because if they expect a recession, they're going to say, I expect to hire fewer people over the next year. Mm-hmm. And that's just not a useful data point, in my view. So what we've been elaborating in the story, what we think is the economy will turn someday. Obviously, it always does. And it will probably turn without a lot of warning. It always does. But there's nothing in the data right now that expects that from our understanding, I should use my understanding for this, but my understanding is that from where we are today, there's no obvious reason for the economy to turn down. There's also no obvious reason for the inflation rate to suddenly, magically revert to 2% or zero or anything else. And it's, as we can talk later, the inflation is a process which has, to some extent, a life of its own. And so there's got to be either some effective policy impetus to change the rate of inflation, or it'll just tend to keep going on at the rate it is today. My reading of that is it's around 4 or 5%. Don't know exactly where it is, but it's there. That's significantly above the Fed's target of 2%. All the labor market data suggests to me that we're at or over full employment. So it's hard for me to understand why a Federal Reserve that's looking at an economy with an inflation rate roughly double its target and is at or over full employment, why they would ease policy.
Okay. Yeah, just to respond to some of those points. So the last part there, you're saying there has been this hope, at least, or expectation at the very least, in many quarters that, oh yeah, pretty soon the Fed's going to start cutting short-term rates as the economy softens. And you're saying, well, if we just look at the actual data that pertain to existing things right now, like what's the unemployment rate right now, not what do business leaders think it's going to be in 6 months, but what is it right now, and what is CPI running at right now, that on either score, you've got unemployment is still at historic lows, and consumer price inflation is running a lot hotter than the Fed's ostensible target. So why would we think they're cutting anytime soon? Is that
right? It's not rocket science, as they say. I mean, it is pretty simple algorithm.
So the obvious response then from some quarters would be to say, oh, you're right. If we just had this, but the whole, we're trying to anticipate, and one major, people have their different pet leading indicators, but one standard metric is the yield curve. And, depending on how you frame it, but since, let's say, the 1960s, correctly defined, the yield curve, if it's been inverted, I think maybe there's one near miss or something. But other than that, it's like no false positives, no false negatives, that when the yield curve has inverted for at least sufficient duration, there has been a subsequent recession, close enough that it's not just like, in general, there's going to be a recession at some point. But no, if you look at a chart of it, it does look pretty compelling. Hey, the yield curve's been inverted for a long time, Mike. So are you saying this time's different, or what? What's your reaction to that?
Yeah, okay. I mean, and that really is the key point right now. So I'll tell a story. Several years ago, I was on an investment advisory committee for a consultant for a very large European insurance company. And they had an excellent in-house research staff, because unlike most insurance companies, they do their own investing. And they asked a young economist, a very good young economist, just to spend considerable amount of time and money looking at any indicator for recessions. Can you find anything out there in the statistics that is a reliable predictor of recessions? And she did a great job. I mean, this is just not looking at a chart. I mean, she really did the econometrics correctly. Mm-hmm. And she concluded that, well, no, but the only thing was that yield curve inversion passed all the tests, not just the ones that you mentioned, but all the tests as reliable indicator. I was really interested in that, and I was asked to comment on the research, so I dug a little deeper, and what I found, to my satisfaction, was that it was absolutely right. The yield curve was not just the best, it was the only useful indicator of a recession. So I looked at what happened. Now, what happened in all of those episodes was that there was an aggressive and surprise, what at that time was a surprise, tightening of Federal Reserve policy, usually because of incipient inflation scare. And in those months and quarters when the curve inverted, it was the short end that went up, not the long end going down. The short went up for a very good reason. The federal funds rate was aggressively increased. And I think the key point is that it was increased to a level that was substantially above the inflation rate at that time. So the real federal funds rate, that is the nominal federal funds rate, adjusted for the then inflation, not the expected rate of inflation, but the rate of inflation right then was an unusually high positive number. And that caused policy reactions, and I was there for some of them. Yeah, they caused recessions. Think of the Volcker shock data. Yeah, Paul Volcker absolutely caused a recession. In fact, he caused the biggest one-quarter fall in GDP in history since World War II. And he did that by raising the federal funds rate very aggressively, way above the then rate of inflation, that is a contemporaneous rate of inflation. And that caused recession. So I concluded, yeah, sure. Sufficiently aggressive monetary policy from the Federal Reserve will, in general, and apparently almost always, cause a recession. So now let's look at the current episode. None of that fits. The Fed actually lowered interest rates to zero. So the inversion came because people expected a recession, but they didn't get the restrictive monetary policy. It wasn't triggered by restrictive monetary policy. And maybe equally important, there was the biggest fiscal stimulus, non-war fiscal stimulus we've ever seen because of the pandemic. Now, both of those probably were, in my view, the right reaction, but they were certainly nothing like what was going on the ground, certainly nothing like what happened in the past episodes where the inversion of the yield curve correctly forecast the recession. Basically, I think we're still there. We still have, although on top of that, we were also dealing with a bond market and the participants of the bond market who had never known anything but falling interest rates and falling bond rates. The way to get rich and live happily ever after for a long time has been to predict the interest rates are going to fall and we're going to stay around zero. Lots of even academic papers saying that. It was kind of a perfect storm. It was a case where now you're in the ultimate logical loop. People see this indicator, as you correctly pointed out, which had always worked. Mm-hmm. It always worked for a particular reason, but that reason wasn't here now. But it really heavily conditioned expectations. It also heavily conditioned expectations to the bond market, which was what they thought was normal. They thought what was normal was zero real interest rates, low inflation. So not only did we have this indicator of the inverted yield curve, but it indicated that we were going to go back to normal. And that's a powerful psychological influence. So I don't know, I was probably talking too much about too many strings of logic here, but that's the basic story.
Okay, great. So yeah, let me try to repeat some of that back to you, distill it down, and then you can confirm if I got it right or tweak it if I'm off. So you're saying, yes, it is true that since at least the 1960s for sure, and then there's some other issues with world too, but the inverted yield curve is not only just a good indicator, but the only good indicator of an impending recession. Historically, it has served that role. But you're saying when you looked back to see specifically like what was the causal mechanism, or at least to push it back one layer of analysis, that you were saying it's not merely that there was an inverted yield curve, but more specifically, if you looked at what we might call the real federal funds rate, and the chart you guys use in your blog post here, and we'll flash that up for those of you who are watching the video. We'll flash that up at some point here as I'm talking. If you look at what's the federal funds rate minus, I think you had the core CPI, but like you say, like the actual change, then extrapolated out, like what would that be on a 12-month span? Right. What continuously compounded rate? Right. That gap is big, for all those prior episodes that are going to go into the recession. So your interpretation economically, what's happening is, when the Fed slams on the brakes effectively by jacking up interest rates in real terms, that's a shock that causes the economy to crash, but brings down inflation. So it performs the Fed's role and kind of fits the standard story of if inflation's getting out of hand, the Fed can slam on the brakes and brings inflation down, but then unemployment spikes. That kind of standard story. But this time around, even though it might look to the casual observer like it's the same pattern, actually, even though the Fed has been rapidly raising rates, Fed like the federal funds rate, let's say, that's really, when you take into account how high consumer price inflation has been, it's not so much that they're slamming on the brakes, but they're just, kind of taking their foot off the gas, if you will, if you want to use the car metaphor. And so you don't really see, even though, yes, the yield curve has been inverted, when you break it down into the specifics that you were looking at in terms of all the past episodes, the gap, for that chart you guys did, the gap of what's the federal funds rate above the contemporaneous CPI or core CPI rate, it's positive, but it's not nearly as big as it was for the preceding recessions. Is that right, what I just said?
That's right. That's basically it. And as you know, one of the reasons monetary policy is thought to be effective, or is thought to be much more effective when it surprises people, not when it behaves as everybody, if it's already, written into everything. And so the surprise here to me, certainly, was that the Fed was easy. Really not such a surprise. We had a huge supply disruption. We had an unprecedented shock to the real economy and to relative prices. And so to think the Fed in that environment would be aggressively raising the real federal funds rate, I don't think it would even have been appropriate, much less effective. And I really would also emphasize the fiscal side of it. We dumped a lot of money, something like $3 trillion into people's wallets over a very short period, most of which they saved. They're still spending. One of the issues right now is that that's gone up. But yeah, that's the basic story. As I'm sure you've noticed, and as a lot of people have noticed, is that monthly inflation number is very noisy. As you said, it's a 1 month change, annualized, so that it has the same dimension as the federal funds rate. And it moves all over the place. So it's not surprising to me that part of the equation, what is the contemporaneous rate of inflation, is sometimes missed.
Mm-hmm.
Right now, what's the real federal funds rate now? Well, the federal funds rate, we know, is 5.5, but what's the real federal funds rate? It's anywhere from -1 to +1. Because we don't know what the inflation rate is today,
Right.
And we'll have an opinion about it in a month. We'll have a different opinion in 6 months, and we'll have an even different opinion in 12 months of what the inflation rate is today. So you just want to be a little careful in how you interpret any set of numbers, obviously, but those numbers are volatile. And you could probably come up with a valid set of measures that would soften my point, and you could come up with some that would increase my point. I think the one I presented was a fair one, but it's certainly not the only one.
Mm-hmm. And I'd like to, you made the point, even as you were just originally giving me the first exposition there, what your thoughts on the yield curve, because I've made the same point that a lot of people like Paul Krugman, for example, in his New York Times column, when he's explaining to the public, why does the yield curve inversion tend to go hand in hand with a subsequent recession? And he makes it an expectation story that, the markets, they sense that people with skin in the game kind of sense that a recession's in the offing. So they predict short rates will eventually be much lower. And so that's why longer term rates fall, even though the short rate right now is still high. And that's why you get the inversion. But so there he's kind of saying, the reason the yield curve predicts a recession is everyone knows a recession's coming. It seems kind of goofy, like you're arguing in a circle. Like everyone in the market's looking to the yield curve because it's telling us what we already know. And that seems kind of goofy. Whereas I like yours that you're saying, no, it's the Fed, tightening that's causing the recession. And so that dovetails with my framework. I'll just mention, Mike, I don't know if you want to react to this. A difficulty I had is, so for a while, since the yield curve has been deeply inverted, I've been warning people about this, and I didn't like the Fed's expansionary action. I thought it was too aggressive and so forth. So that all fit my worldview. But what I wasn't prepared for is how long it's been inverted, right? In terms of trying to give people guidance as to timetables. If you use the past inversions as a guide, you'd say, once it first broke through, the exit, the 0 point, usually within this many months or so, there's a recession. But this one, that would screw you up because it's been inverted for so long compared to most of the prior episodes.
No, it's just that we haven't had the recession.
Right.
That's what turned around the yield curve was the recession happened, and then we went back to a normal. I had a part of the thing that we published that was taken out by somebody, probably for a good reason, was that, suppose you're going along and suddenly somebody says, hey, the Fed's going to substantially ease monetary policy. Well, your first reaction would be, well, great. Off to the races. They said, no. That means we're going to have a recession. I said, that doesn't make any sense. I mean, if you think because of the recession, that I can buy. but there's not going to be a recession because the Fed lowers rates. That makes no sense at all. Maybe that was just too obvious. I don't know. But I thought I liked it. But
I do too. And I like because you're dovetailing, and maybe that's why you brought up the earlier thing about making a pure expectation story where you're just arguing in a big circle. Yeah. So it's why is this giving us new information? And it looks like the Fed monetary policy doesn't have anything to do with the business cycle per se and some versions of that story.
Right. And I think one of the lessons from this is that, which is easily implementable, is that people should, at least as an alternative, should have an expectations-free set of macro data to look at. They should look at what the numbers, as bad as they are, right, are saying about where we have been recently and where we are now. And they should take out all what everybody else thinks. So what good is being a forecaster if what you do is repeat what everybody else thinks?
Right. Yeah. So again, just to make sure people get your point, that you're saying a lot of the numbers and data that conventional forecasters or just whatever, guys running Twitter accounts or something and talking about the financial markets might be incorporating into their ostensible predictions are themselves merely aggregates of other people's opinions about the future. And if you're trying to say like, no, what do you think? Normally it's, so if you went to see the doctor and said, am I sick? You wouldn't want the doctor just to survey 100 other doctors and see what they thought and then tell you what they said. Like, you'd want him to.
Yeah. I mean, if I'm looking at a big data set and everybody else is looking at the same data, that's one of the things which I've always wondered about too, is that everyone is looking at the same what really is a very small data set about what's going on in the U.S. economy. And everyone knows that none of them individually or even collectively are very good at forecasting the future of macro behavior because it's just too complicated. Hundreds of millions of people behaving in ways that are to some large degree unpredictable. And so what seems to be a really interesting question is, how do we get this widely held consensus forecast? There shouldn't be a consensus forecast. Forecast should be all over the place because that's the nature of the underlying process. So, I mean, there's something wrong here. And in this case, I think we've just fooled ourselves into believing that something's, and by the way, we still are. I mean, the reaction of the bond market the last couple of days has been exactly, finally, we're going to be right. Finally, finally, the sun is going to shine on our macro forecast. I remain skeptical. I mean, it'll happen someday for sure, but I don't see the evidence for it right now.
Okay, yeah. So if I could just tease out, and to put my cards on the table, I am bearish, and for the yield curve among other reasons, but I am admitting there's difficulty, and that's why I liked your analysis and wanted to have you on the show, Mike. Is that of the critiques of using the inverted yield curve to show, hey, I think there's going to be a recession soon. Yours was the best one I've seen, where you did give like a theoretical reason as to why the previous times actually were different from the current ones. That's why I wanted to make sure our listeners got that perspective. Is your position, hey, we have no reason to think there's going to be a recession this calendar year, or is your position more, I'm pretty sure there won't be?
No, this is the first.
Okay.
I mean, I look at everything I look at when I put together my analysis of the numbers simply suggests to me there is nothing I could point to and say, oh, yeah, we're in trouble. There's one thing which I think it will be important, but not decisive, and that is that the excess savings that people built up during the pandemic, both because they got huge transfers from the U.S. government and because they couldn't buy a lot of stuff, those seems to have worked out. Now, if that's true, then the savings rate, which right now is historically low, is around 3%, could jump back to something more like normal. That could happen, and that would, other things equal, cause a slowdown in the growth of aggregate demand and maybe a slowdown in output. But I think the contrary evidence to that is that the private sector's balance sheets are so strong now, stronger than they have ever been, that I think people have a lot of room in their financial net worth to continue spending at a good rate. So, yeah, it's more than a couple of things that might be negatives I've looked at, and I don't think they're strong enough to cause a downturn over the next year.
One thing, if I just ask you some more random ones at this point, all on the same theme. Well, one thing I saw making the rounds a few days ago on social media was some charts showing the unrealized losses, I guess, on treasuries that the commercial banks, maybe investment banks too, are sitting on. Like, oh, SVB went down, and the fear was lots of banks are sitting these treasuries. Interest rates went up. They took huge losses if they marked to market. And do you worry about that at all?
Sure, and I've actually written on that specific thing that there's clearly is a very large losses out there, and in the past they have caused big problems because they were in banks or institutions that had deposits that people could withdraw, and because of lack of information, when people found out who held the bad paper, like in 2008. They pull their money out, the financial institutions collapsed, and that causes a recession fast.
Mm-hmm.
Could happen again. Again, from what I've been able to find, I don't find a smoking gun anywhere. The banks are pretty well capitalized. And fortunately, the reaction to 2008 was tighter regulation of what commercial banks could do. And that has meant that a lot of their activity has moved out of the banking sector into unregulated sector. The bad thing about the unregulated sector is we don't know much about their balance sheets. We don't know anything about most of them. The good thing about them is that they typically don't have call liabilities. Private investors, if their investment goes bad and you come and get your money, they say, "I'm sorry, you've lost." So it may not be it's a very large problem, but it may not be one which threatens, say, the banking system or the formal credit system.
Okay. What about, do you have any thoughts on the labor market that I think in terms of the listeners and when these episodes drop, I think probably the prior episode to this one, I had a guy from the Heritage Foundation on who, as you can, guess, he tends to be, the right wing of the American political spectrum. And so he takes umbrage at the Biden White House citing so much credit. Look at these great, unemployment stats and so forth, and thinks there's a lot of those numbers are misleading. Are you in that camp at all, or do you think no, prima facie these unemployment numbers are basically what they seem to be saying?
Absolutely, they are. It's clear. Those numbers are clear.
Mm-hmm.
I mean, you can't argue with those numbers. No matter how you look at it, the labor market is extremely strong, and if it's softening a little bit right now, it's still much stronger than it was in the 4 years before the pandemic. All right, so I don't think there's any basis to argue with those numbers.
Okay. Another one that I'll throw at you here in this sort of flash round is, I was a bit surprised when mortgage rate, so the Fed jacked up, the rates that they have more explicit control over, of course, federal funds rate, short-term, T-bills would tend to follow. But as mortgage rates rose fairly rapidly, I expected home prices to come down, and they didn't really do that. Do you have any thoughts on that?
Yeah, I mean, I was surprised too. I think after the fact, it's pretty clear what's happening is that people that have a 3% 30-year mortgage have a capital gain. That's probably the biggest capital gain they've ever had in their lives on that that liability, right? So, I mean, people have trouble getting their minds around the fact that you can get a capital gain from a liability, but you can, right? Those people are not going to sell those houses. They're going to rent them. And the rental rates actually will be artificially depressed for a substantial period of time. And I think that's why there's just no supply. People are not selling their houses. Something like 9 out of 10 mortgages in the U.S. are fixed rate now. That was also a reaction to the 2008 debacle.
Right.
So we said, boy, we're going to bulletproof this mortgage market. We're going to encourage it. And rates were falling, right? So everybody who was conscious locked in a 30-year low interest rate. So now we have, mostly through immigration actually, but we still have a growing population, and household formation is kind of behind, apparently. So there's substantial demand for housing, there's no supply. And that's going to keep prices. I think this will eventually adjust. At some point, somebody's going to have to buy a house with a new mortgage. It's not somebody who's cashed in their stock or something like that, and it'll begin to bite. that in general is the big uncertainty now, right? That financial markets and housing markets have adjusted remarkably well to this new reality. That's got to erode over time, but we just don't have any good idea how fast.
So just to repeat that back to make sure I got it and the listeners get it, you're saying, yeah, the standard story that still makes economic sense is other things equal, mortgage rates come up, somebody with a given income who can afford a given, house payment per month means at the higher mortgage rate, the capitalized value that's a lower price of a house they can afford, right, given their income and how much, they want to devote to their house payment each month. And so other things equal, you would think, the demand for houses would drop and that would make the market price of new sales go down. But there's a flip side here that because mortgage rates rose so rapidly that, somebody who's, sitting in a house and they get locked in their mortgage earlier, now if their job wants to relocate them or their kid needs to go to a different school or whatever, they're getting married and they need to move to it, they're not going to sell that old place. They're going to keep it and, like you say, rent it out at the very least. And so there's a lot of housing being kept off the market precisely because rates rose, which paradoxically is helping to prop up the price.
Yeah, it's I don't think anybody anticipated that one. That is a good one. I mean, the other thing, let me add, at the risk of being professorial, that usually when you see a big loss, like I said, okay, people got a big gain. Well, you got to ask yourself, who took the loss? Well, it wasn't the banks because they continue to package up the mortgages and sell them to somebody else. Mm-hmm. Okay, so that loss is somewhere out there, right? But it's in a extraordinarily illiquid position, and there's not much they can do about it.
Right. Well, I guess the holders of like mortgage-backed securities or something that they had a market,
exactly.
Like they took an implicit loss.
Those are like insurance companies. Yeah. Right. And indeed, insurance companies all over the world. So the counterpart of the capital gain for U.S. homeowners is a capital loss, which is spread over entities that are not going to play much of a role in aggregate demand in the United States.
So I guess big picture, then you think that there's no like obviously everyone should keep watching new data come in, but you think there's no reason to expect a recession anytime soon, or at the very least, people who are saying, "Oh, there's going to be a recession," they have nothing really to point to make that case. Is that a way of summarizing your perspective?
I think that's right. Yeah.
Okay. Any final thoughts for our listeners on these matters?
No, I mean, just the other big unknown now is what is the level of persistence in the inflation rate in the United States today? As you know, you and I were almost brought up on those arguments, right? Mm-hmm. Market power and so on and so forth. I think it's fair to say that we don't know a lot about that, and we don't know a lot about how it's changed. So I wouldn't be real confident the inflation rate on its own goes back to anywhere. The inflation rate on its own, in my view, stays where it is now, because that's what people will build into their pricing decisions. Again, if they expect prices to fall or they expect a recession, they might be hesitant about raising prices or maintaining this inflation rate. But I think that'll be overcome. And so we're going to have to get either good luck, energy prices, or a more aggressive monetary policy if we want to get inflation back to 2%.
Okay. And again, that feeds into your overall perspective that unemployment is still quite low by historical standards. You see no reason that CPI, that those numbers are going to trend down over the coming months. And so why the heck is everyone so sure? Oh yeah, the Fed's going to cut because of the upcoming weakness, that you don't see it. Okay.
Right.
Okay. Well, thanks to a good perspective. Like I say, I think you and I are in agreement on a lot of the big picture things, but the tactical specifics, I'm more bearish than you are, but that's why I wanted to have you on, to make the reasonable case for someone who disagrees so our listeners can get both sides. Folks, my guest has been Dr. Michael Dooley, the Chief Economist for Figure. Mike, thanks so much for your time and your insights.
Interesting discussion. Enjoyed it.
And thank you, everyone, for tuning in. We'll see you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.